if you saw my Q4 preview video that I did, you'll see that I had a table of potential outcomes for Q4 of 2023. But I thought since doing that video, I could have done a better job of trying to break down the various scenarios and possible outcomes for the full year 2024. And this video is partly inspired by there's sort of a thread here of a few different people were chatting on Twitter about, hey, what might their adjusted EBITDA potentially be, and what might they then be guiding for 2024, and then how might the market react to that? So I wanted to try and fit this in before Q4 results, which are coming out, which I know we're all excited about, coming out in a couple days. So I have a few different outcomes, or a few different scenarios we're going to just sort of break down and think about here. So let me just pop in the results for adjusted EBITDA. You can pause the video, look at them right now, but I'm also going to explain them. So if you have two different boxes here, one is for a customer count of 2.7 million at the end of the year, and the next one's for 2.5 million. And a slightly lower premium per customer, $394, which gets you $986 in-force premium. The other one, 2.7 million, which is what I was showing in my last video, $400 premium per customer, gets you about that $1 billion, $80 million mark. And in my previous video, this top line here is really what I was highlighting and talking about as a potential scenario for 2024. Is that, maybe they get to this top line, and then maybe they have a 75% gross loss ratio and $129 of customer acquisition costs for each customer that they acquire, and as an overall average, and then 45% operating expenses gross, or your expense ratio, 45%, gets you to that $176 million loss. But it's kind of a problematic number, 176. If this is exactly what is what they're expecting and what they forecast and what they guide for, minus 176 million. I don't think the market's going to love that, because right now in 2023, even with a fairly bullish Q4, at least what I'm expecting, at least what I put into my model, my scenario for Q4 adjusted EBITDA for the whole year is $164 million loss. So $164 million in 2023, and then you sort of are saying, hey, maybe it's going to be worse in 2024. That's really not the market, and investors are not going to like that. So I was thinking about, though, that there is a good argument to be made that some of these numbers were a little bit. It could be better than these numbers, and then the results, even fine-tuning some of the inputs, can have a big effect on the output, as you can see right here. It go for $176 million down to this sort of better scenario, $123 million loss. So how did we get there? What are the sort of inputs I'm changing? First one is the loss ratio, gross loss ratio. So if it's 75%, you get this result. If it's 70%, for example, then you're down to, that's the only thing you change. 70%, you drop $23 million improvement if it's 75% to 70% across the year. So obviously, maybe you think 70%, that's ridiculous. How are they possibly going to get to 70%? But if you think about it, they end this year at $750 million. So $750 million, type that in, $750 million, but they're actually, on top of that $750 million, they're kind of getting another $100 million up to $850 million for free over the course of 2024, just from rate increases. So it's kind of like an 88% ratio. You multiply that, say the loss ratio comes in at 74% for Q4, for example. Say that's where it kind of roughly is, 74%, and there's hardly any CAT events at all. That means then, just by adding in that amount of additional premium that you're kind of getting for free just from increasing prices and rate increases taking effect, you're getting a loss ratio that's somewhere maybe more in the mid 60% range. So then maybe you think, well, maybe it's 5% more per quarter average in CAT events. Maybe 70% is really not that far out to lunch. Maybe that's a more realistic number, and it has a huge effect on adjusted EBITDA. It drops down to 153. Now, the next line, I go back to the 75%, but now we're at $100 of CAC expense. And CAC, we'll just bring up the chart for that CAC history. I mean, the last few quarters, it was $80 a quarter they're acquiring customers. $80 a quarter, and that's because they're really pulling in those pet customers, renters customers. They're probably going after very few of the other home car sort of customers, unless those people are just like the lowest hanging fruit for them to pluck out of the market. But otherwise, they're probably avoiding them and going for those other product lines. So $80, $98 a quarter before. So the last two, I mean, if they continue that same approach, maybe $100 is realistic. But obviously before that, as you can see the bars here, it's been quite a bit higher, 130, 100, I would say more like 130 kind of range, average even higher. So that's why I previously had $129 in. I'll flip back here to that table, but I moved it down to 100. If you move it to 100, you go from 176 down to 146. So huge improvement there. That's that $30 million improvement in adjusted EBITDA, just because you're acquiring so many customers, you're overcoming customers that are churning to get to that bigger customer count. But so instead of paying $129, you're only paying $100. Massive improvement. So if that happens, 146, if you combine the 70% and the $100, 70%, $100 improvement, then you get as low as $123 million. Again, this is at the bigger sort of customer count, 2.7 million customer count. So big improvement from 176 million. And thinking about it, I'm like, it's probably, this may be too bullish. This is probably too bearish. I'm going to think maybe somewhere in the middle. So maybe it's $150 million is more realistic. And I think if they guided for something like that, hey, the market, I think, would see that more positively, especially say they do $165 million loss, say, in 2023. So then you're still improving in the same direction, still hit peak losses. Peak losses are behind you, still growing towards profitability. Okay, and then the other whole table here, exact same thing, but the customer count, your top lines are different. 2.5 million, not as much growth, a little less premium per customer, a little less, you get to a little less, about 100 million less in in-force premium. Same idea here, but at the top, because you're growing so much less, 200,000 customers less, your adjusted EBITDA looks better already versus the scenario here. But then moving down the line, you get all the way down the one at the very best scenario, 70%, $100. You're back at 117 million versus 123. So again, even if you're say somewhere in the middle, maybe they actually guide 150 something, and then they actually hit $140 million loss, something like that. I think, again, the market would be very pleased with or happy with to see them on that right track. So I just wanted to share that, guys, with you all. Thank you so much for watching. Feel free. I'm so excited for Q4 earnings, which I know you guys are. Everybody is as well. Let me know what you think in the comments down below. Hit me up on Twitter. If I'm slow to DM you back, I'm just busy, and I'll get back to you. We'll get back to you eventually. But thank you, everybody. This Lemonade community is super awesome. It's growing, and there's so many bright people that are just. I think we're all getting better and learning from each other. So really appreciate you guys watching my videos and your feedback on all of them. Thanks for watching. Remember, it's in the bag.